Okay, it is now live.
Okay, I think we're going to make a start. Good morning if you're joining from, say, Europe or Africa. Good evening if you're joining from Asia, including Southeast Asia. And good day to colleagues joining from other places. Thank you for spending your time with us for the next hour or so. And we're very pleased that you've joined in to listen to this very interesting presentation. So my name is Emmanuel Adigbite. I'm the lead for the Cluster on Ethics, Organization and Society of JCUS in Singapore Business School. I want to, first of all, that we will be recording these for, of course, marketing and other purposes. However, you'll be able to ask questions at any point of the webinar if you use the Q&A function, and my colleague Riping will be able to see those questions, or she may decide to look at them at the end and then by all means answer them. Most of the time, we will choose to answer the questions at the end of the presentation, but of course, this is all up to Riping. There will be a satisfaction poll and survey at the end of the webinar. Please, by all means, we'll be glad if you can leave your thoughts by completing the satisfaction poll and survey. If there are technical issues, perhaps you're not hearing well or you're not seeing the slides, by all means use the chat button function, which we will see behind the scenes, me and my colleagues. But if you are asking questions in relation to the seminar or webinar in this case, please use the Q&A function. So without further ado, I would like to welcome Associate Professor Riping Zhang, my very dear colleague, who is also a member of the Ethics, Organization and Society Research Cluster. For those of us who are joining this cluster for the very first time of this webinar series, the EOS Research Cluster was formed in 2022 at JCU University, JCU, Singapore campus. But there are members of the cluster from JCUS, that's the Singapore campus, but also from Australia. And it's a very multidisciplinary, if you like, scholarly enterprise with input from accounting, finance, accountability, etc., governance, CSR, sustainability, environmental reporting, but also outside of what you could classify as business school disciplines, input from philosophy and theology, and some of these other fields. So today we are going to be hearing a finance perspective, and Riping is associate professor at JCUS. She's been in the position since September 2015. Our research focuses on the effect of liquidity and asset returns, return co-movement, and empirical asset prices in international financial markets. Briefing is very well published in high-quality finance journals, including the Journal of Financial Economics, Journal of Banking and Finance, Journal of International Money and Finance, Journal of Empirical Finance. And prior to joining JCUS, she was Associate Professor of Finance at Shanghai University of Finance and Economics in China. So without further ado, Wei-Ping, the floor is yours. Thank you very much for your attendance this morning or this evening.
Thank you, Emmanuel.
Yeah.
Okay, sure. I will share my slides for today's presentation. Okay.
Can see it.
Can see?
Yes, we can. Maybe if you do the presentation. Yeah, that one. Yeah, please.
Okay. Okay, so let me change the layout a little bit. Okay, good day to all of you. Okay, thank you. So today I'm very glad to present one of my recent papers. The topic has been changed a little bit. The new topic is information transmission from bond to stock markets. Later you will know why, okay? This is a joint paper with Alaudin from EOS, Sheridan from UT Austin, and Jason from University of Toronto. The paper was actually motivated by two primary observations, okay, about bond and stock markets, okay. The first one is that we noticed that stocks and corporate bonds are traded on different platforms, right? So usually stocks are traded in liquid, centralized stock exchange, whereas corporate bonds are traded on less liquid and usually a dealer market. Okay, so this is the first observation about the difference between the two kind of securities or assets. The second observation is that although bond investors and stock investors, they buy claims of the same firm, right? But usually they do so for different purposes, right? So they focus on different information. For example, equity investors, stock investors are more interested in evaluating a firm's upside potential, right? On the other hand, bond investors are more interested in assessing the firm's downside risk, right? Because they care about the default risk, right, etc. So because of this, we believe information discovered by the participants in one market is likely to be relevant to the participant in the other market, right? So information can be transmitted from one market to the other, okay? So actually, there are many papers showing the information transmission from the stock market to the bond market. Why? Because stock market are more liquid, right? And more efficient. So price incorporation usually occurs in the more liquid, more efficient market, which is the case. See, many studies have shown this. There's very little research about predictability running from bond market, bond returns to stock returns. But this is our focus, okay? We try to examine where bond returns can predict stock returns. So the key question we try to ask is, are stock returns predictable using past bond returns of the same firm? Okay, So thus, bond to stock market predictability may seem counterintuitive, right? Because we know bond market are less liquid, right? However, models involving limited attention, segmentation, and overconfidence may suggest the predictability running both ways. Okay, so as I mentioned just now, we argue that bond and equity investors often differ in objectives and attention when they trade claims on the same firm. Okay, so bond investors are more sensitive to downside risk and default probabilities, and they tend to be more institutional and informed. So there are much more institutional investors in the bond market than in the stock market. Okay, so those factors make bond returns especially informative about credit fundamentals. Okay, on the other hand, we know equity markets tend to attract more trading volume. Okay, so most cases, this means this market is more efficient, right? Because more trading volume means price can be quickly incorporated into the price. Okay, but this high trading volume can also attract retail investors, small investors, which could make the price noisier, stock price noisier, rather than more efficient. Okay, so those factors combined together raise the possibility that bond returns can reflect information that equity prices incorporate with a delay. Okay. So if we can find bond returns can predict stock returns of the same firm, we want to further evaluate the nature and driving force of this predictability, right? So in particular, we look at factors such as credit risk, lottery-like stock characteristics, relative trading in the bond market, relative to the stock market. Okay, bond trading relative to the stock market trading, and also the trader type of the bonds, whether it's more institutional or more retail. Okay, so first two factors, credit risk and lottery-like stock characteristics, will attract more retail equity investors, which will make the stock price noisier. Okay, then the next two factors, trading in the bond market relative to stock market and bond trader type, will make the bond market more efficient sometimes, right? If you have more institutional investors in the bond market, typically bond market will be more efficient, and we will expect stronger return predictability in this case. Okay, so we'll look at this specific factors and look at the impact on the stock return predictability. So I'm afraid I don't have enough time to cover all the analysis. So just give you a quick summary of my main findings. First of all, we uncover a very robust predictive relationship where bond returns lead future stock returns. Okay, and this lead-lag effect is more pronounced for firms with lower credit quality, higher financial distress, and more lottery-like stock characteristics. Okay, and we also find that bond returns exhibit stronger predictive power for stock returns when bond trading activity is relatively higher and institutional investors are more active in the bond market. Okay, so all of this are consistent with our expectations. And also, we find that bond returns can be firm-specific cash flow information rather than discount rate information. Okay. And also we look at the timing and speed of the predictability, and we find that the predict power of past bond returns for stock returns is strong in the first week of the subsequent month, and it remains meaningful and important thereafter. Okay, so this shows a gradual information diffusion from bonds to equities. Okay. So in terms of contribution, this is the first comprehensive study to examine the predictability running from corporate bonds to stock returns. As I mentioned, right, many studies focus on the opposite, right? But we try something new. And we also investigate the reasons for the delays in price discovery and show supportive evidence for the information transmission from the bond to the stock markets. Okay. And we also propose a new measure, which is very important for this information transmission. This measure is the bond trading activity relative to stock trading. And we find that this measure strengthens the predict power of the bond returns for stock returns. Okay, our data for bond data, we download the transaction level data from Trace, stock data from Crisp and CompuStat, and then rating data from Capital IQ. Institutional ownership data is from 13F. And we follow the standard ways to clean the bond data because bond data very messy compared to stock data. Okay, and the two data sets are merged using the bond crisp link file provided by EOS. Our sample period is from July 2002 to September 2021. Okay, so on average, we have around 600 firms per month, about 185 in the high yield group and 308 in the investment group. So some firms don't have the valid S&P rating data. Okay, so this page shows you the key measures used in our analysis. The first one is about monthly bond return. Okay, so unlike stock return, whose calculation is very straightforward, right? Bond return depends on price and also depends on accrued interest and coupon, right? Coupon payment. So follow the literature. We use this first formula to calculate bond level monthly return. Okay, so the price here is the volume weighted price. So a bond can trade many times on a day, right? So we use a volume weighted price on that day at the end of the month, actually. Plus accrued interest and coupons, if any. Okay. So to focus on the more liquid, more active bonds, we require at least 3 daily trades for each bond. And we exclude dealer-to-dealer trades. And we also require the bond to trade in the last 5 days of the month. Okay. So one firm can issue many bonds. Okay, so once you have the bond return, we will calculate the firm level bond return. Okay, so the first formula is for each bond. Second formula is for each firm. Okay, so firm level bond return is actually the volume weighted average of bond return. So this weighting scheme assigns higher weight for more actively traded bonds, right? So this is to mitigate the concern of bond price being unduly influenced by illiquid bonds. Okay. This is our new measure. the bond to stock trading volume ratio, or BS ratio. Okay, so in the numerator, we have the total dollar trading volume of a firm's bonds in a month. And in the denominator, we have the total dollar trading volume of the firm's stock in the same month. Okay, so a higher value of BS indicate that the firm's trading activity is more concentrated in the bond market than in the stock market. So this suggests that bond investors may be more active in processing and reacting to firm-specific information. Okay, so this is one of the first key results as shown in panel B of our table 2. Okay, so this is our first evidence of cross-market return predictability. What we did is as follows. So we can just focus on this panel B2 within this red rectangle. Okay, so what we did is at the end of each month, we sort firms into 10 portfolios based on their bond return in this month. Okay, 10 portfolios sorted based on the past bond return. And then we look at their returns in the next month. Okay, so loser means the portfolio with the lowest bond return in the past month. Winner means the portfolio with the highest bond return in the past month. Okay, so those numbers are for their stock return. Okay, all the values shown here are for stock return. So for the loser bond portfolio, their return in the next month is about 0.5%. And then for the winner portfolio, their stock return, this is value weighted stock portfolio return, okay? Their return is much higher, around 1%, right? 1% a month. And the difference, WML, winner minus loser, is around 0.5%. In raw return, this is not very significant, but for the risk-adjusted return, for example, based on CAPM model or based on Farmer French 6-factor model, the winner minus loser has a very significantly positive stock return, right? Around 0.9% a month, right? So both are significantly positive, statistically significant. So this shows that past bond returns can predict future stock returns. So if bonds perform poorly in this month, right, the stock return of the same firm will be very low in the next period, right? And then if bond returns are very high in this month, the stock return of the same firm is going to be high in the next period, right? So bond return can predict stock return. This is our first finding. And we show that these results are very robust. It's robust to alternative weighting schemes, either equally weighted or volume weighted, okay, when we calculate the portfolio returns. We also divide all firms into high yield and investment grade, and we find that this predictability is much stronger in the high yield firms. Okay, in C1, we have the high yield firms, right, where the distress risk or credit risk information is very, very critical, right? So we find stronger predictability using bond returns. But in IG firms, investment grade firms, there's no such predictability. Okay, next we look at the effect of bond trading on this stock return predictability. Okay, so we did a 3x5 independent portfolio sorting by the BS ratio and bond returns. So what we did is at the end of each month, we have 15 portfolios. Okay, so for all firms, we first have 3 groups based on the BS ratio. So we have low, medium, and high. And then we also simultaneously divide all firms into quintile portfolios based on their bond return. So we have loser, quintile 2, quintile 3, quintile 4, and winner. Okay, so altogether 3x5, we have 15 portfolios. So this table shows you the winner minus loser for each of the key portfolios, right? So we can focus on the last row, which is winner minus loser for each BS tertial portfolio. Okay, so remember all these numbers are about stock returns. Okay, and large number means a stronger return predictability. And we find that this stock return predictability monotonically increase with the BS ratio. Okay, so when BS ratio across all firms, when the BS ratio is very low, there's no predictability. Winner minus loser is only 0.3 and it's not significant, right? Then for medium BS, we have marginally significant stock return predictability. Then for the high BS portfolio, see, the predictability is around 0.9%. Winner minus loser is 0.9% per month, okay, and it's very significant. And we observe the same pattern for high yield firms, but not in the IG firms. Okay. All right. So so far we have seen my key findings using portfolio sorting approach, right? But the problem with portfolio sorting is that we cannot control for control for the effect of other firm characteristics that can affect stock return. So that's why we will use Farmer Macbeth regressions to double check whether we can still find this stock return predictability after controlling for those effects. Okay. So in model 5, the dependent variable is the stock return for firm I in month T plus 1. Okay, so our key independent variables are shown here within the red rectangle. Okay, the first one is bond return in month T. But we also look at the longer term bond returns, right? Bond return in T minus 1, T minus 2. Okay, and we also include past stock returns and also other firm characteristics that have been shown to affect stock returns, such as firm size, BM ratio, profitability, investment, longer term past stock return, idiosyncratic volatility, and stock illiquidity. Okay, so we expect the coefficient of B return IT or B1 to be significantly positive. Okay, if we can find B1 is positive, that means there is stock return predictability using past bond returns. Then in the next equation, we incorporate the effect of BS ratio. Okay, so we construct a dummy variable high BS, which takes a value of 1 when the BS ratio of a firm in month T belongs to the highest tertile of all firms. Otherwise, it has a value of 0. Okay. So we want to show that C1 in this model 6 to be positive. Okay, so high BS ratio will increase the stock return predictability. And before I show you the result, I also want to show one more regression analysis. Okay, so someone may argue that the BS ratio just reflect leverage or credit risk rather than the relative information, the relative attention paid by traders in the two markets, right? Why? Because if we hold the bond market turnover constant, right? So firms with small bonds tend to have higher BS ratio, right? Firms with small bonds will mechanically have higher BS ratio, okay? Because they issue more bonds, right? So to control for this effect, right, we construct a cleaner version of BS, okay? So we actually calculate the BS residue using this model 8. So we regress BS on variables related to credit risk or leverage, rating, and firm size. Then we use a residue of this model 8 to reconstruct our high BS dummy. Okay, we call this high BSR. And again, we will expect that C1 to be positive in this model 9. Okay, so this is the result from the Fama-McBeth regression. So first 4 columns shows you the raw return as the dependent variable. Last 4 columns shows you the risk-adjusted return as the dependent variable. Okay, but they are pretty similar. So we just focus on the first 4 columns. Okay, so you can see across the, no, not across the 4 models. Okay, model 1, where the BS effect is not considered, the coefficient of bond return in month T, 0.123, highly significant. Okay, and then model 2, here, the coefficient of this interaction between bond return in month T and high BS ratio, high BS dummy in month T is also significantly positive. Okay, and also in model 4, for the high BS dummy constructed using the residue, right? BS residue, the coefficient of this interaction is still highly positive. Okay, so all of these results provide supportive evidence for our argument that bond return show robust predict power for future stock return. And this predictability is stronger when bond trading is higher. Okay, so next, after establish the main finding, right, our next steps are to understand the determinants of this predictability. Okay, as I mentioned earlier, we look at different factors, right? Credit risk, lottery-like stock characteristic, etc. Okay, so this page shows you the result for the rule of firm financial distress on the relationship between bond return and future stock return. Okay, so we assume that overall bond market are more sensitive to downside risk, right? So bond price of distressed firms may contain those forward-looking information about default risk and recovery value, right? So if this kind of information are slowly incorporated into stock price, we will expect a stronger predictability from bond to stock in such highly distressed firms. Okay, so that's our expectation. So we use several measures for financial distress, like credit rating, firm size, stock illiquidity, BM ratio, profitability, investment. Okay, and the first three columns are for the coefficient of bond return, B1. Okay, so if I go back to right, in our model 5, B1 is what we have in the first three columns. Okay, so we can find that B1 are all significantly positive, right, among high distress firms. And then last three columns are for the sum of B1 and C1 in model 6. Okay, sum of B1 and C1. Again, they are consistently positive among all the high distress firms. Okay, so we see that the predictability is concentrated among firms facing higher financial distress, precisely the case where default risk is more salient and closely monitored by bond investors. Next, we look at the lottery-like stock characteristics of the firms. Okay, and we believe that if the stocks have more lottery-like payoff, right, it will attract more retail investors, which will make the stock price noisier and less efficient. And that's why we expect stronger stock return predictability among those firms. Okay, we follow the literature by using 4 different measures of lottery stocks, lottery-like stocks, like maximum stock return in a month, idiosyncratic volatility based on the Fama-French 6-factor model, return skewness, and average price level. Okay, and we also combine the 4 into a single composite index measure. So this table shows you the average stock return of the winner minus loser bond return portfolios across different lottery characteristic groups. Okay, so this is less lottery, medium lottery, and more lottery. So difference is the difference in winner minus loser stock return between the more lottery and the less lottery groups. Okay, and you can find in the last column, this difference is significant for at least 3 measures of the 5, right? Especially for the composite lottery index, it's very significant. So this means we have greater predictability among lottery-like stocks, which is in line with the notion that those stock characteristics exacerbate noise trading and hinder efficient information incorporation into stock prices. Oh, I have 2 more minutes. Okay. So this one is about bond trader type. Okay, we assume that institutional investors are more informed, right? So we will expect a stronger stock return predictability if the bonds are more actively traded by institutional investors. And this is a finding. For institutional group, we have strong and positive winner minus loser stock return. Okay. And next 2 pages shows you some information event study. Okay, so we want to know what kind of information is transmitted from bonds to stocks. So this page is about public information such as credit rating change, where we find no predictability around those public information events. However, here for the firm level earnings announcement, we do find some very strong predictability. Okay, so this means the information from bond to stock is not public. Okay, it's private and it's for firm level cash flow information. Last test is about the weekly stock return predictability. So we decompose the stock return in the next period into week 1 and week 2 to week 4. And we find that for week 1, as expected, the predictability is very strong. However, for week 2 to week 4, we still find strong stock return predictability. Okay, so this means that this stock return predictability reflects persistent information transmission from bonds rather than microstructure effects like bid-ask bonds. Okay, so to conclude, we use a very comprehensive data set covering all the U.S. corporate bonds and stocks to establish a strong predictive relationship from bonds to stocks. Okay, and we find that this return lead-lag relationship is stronger for firms with high distress risk, more lottery-like stocks, and when more institutional bond investors are trading, and when more bond trading activity. Okay, and our event analysis suggests that this predictability is driven by non-public or private information related to cash flows. And altogether, our analysis suggests that 2 distinct mechanisms contributing to this stock return predictability. First one, greater informational content in bond returns due to credit monitoring. And second one, slower information incorporation in equity prices due to behavioral frictions. Okay, and the interaction of the 2 channels is especially pronounced when bond market activity is high. Okay, so that's all my presentation, and thank you for your interest and attention.
Thank you very much, Wei-Ping. Very, very great, very interesting presentation. Lots of things to think about, lots of data work, very strong work. Thank you very much. So I'm going to open the Q&A section. So colleagues listening, if you could please use the Q&A function rather than the chat function for your Q&A questions. So I've got a comment from Tan Yuan to start with. Thank you for the presentation. It's a very interesting research question. Could you please share an explanation for the finding that if bond returns perform well this month, stock returns tend to perform well next month? So the predictability.
Okay, I guess that's about our first finding, which is here. Can you still see my screen? Emmanuel, can you still see?
Yes, we can see your screen. Okay. Oh, yes.
Okay. Okay, so yes, we find that the loser bond portfolio, right, will have lower stock return in the next month. Okay, and then winner bond portfolio. As I mentioned, we look at several possible channels, right, for this relationship. The first one is we have quite several, right? So basically, this information is relevant. We have some information from bond to stock, right? So sometimes bond market are faster. Bond market is faster, especially when this information is about distress risk, and especially when there are more institutional bond traders in this market. Okay, so here the bond price are more efficient. At the same time, the stock price of the same firm may not be that fast. Why? One possible explanation is stock investors may be overconfident, right? They can ignore what is happening in the bond market. Another reason is those stocks may have more retail investors, right? So they actually don't care what is happening in the bond market, right? So their trading makes the bond price noisier, right? So in this case, we will see some information, especially this information is related to credit risk, right? Transmitted from bond to stock. So stock investors will slowly realize this good or bad information from the bond market, right? So this will be reflected in the stock prices with a lag.
Thank you. Thank you very much, Wiping. If you can stop sharing so that the video can just focus on you and I. So thank you very much once again. Colleagues can still put questions in. So I've got a comment and a question from Sukrintan about stock return predictability of bond mainly reflected private information. Can you elaborate on such conclusions? Can you elaborate on how such conclusion is drawn? Thank you.
Sukri, thank you for the question. So information can be either public or private, right? So we show that public information is more used in, I think, around rating changes. Okay, so usually it will take a long time for the rating institutions, right, to adjust the ratings. So by the time the rating change occurs, it's already public, right? So we show that there's no return predictability around those public events like rating change. So this means that this predictability is not about public information, okay? So we go to the private information. Private information can be two things. One is related to the cash flow. So when we talk about private information that can affect stock returns, we can have information about cash flow. We can have information about discount rate or risk premium, right? So we look at specifically cash flow information, which will be revealed to the public around earnings announcement. Okay, but we don't look at the information after earnings announcement. We look at it before. So our window for the earnings announcement is from -2 to +2, the 5-day window. So it's before the earnings announcement, right? So if you have some private information, you will treat before the actual earnings announcement, right? So we find that there's a strong return predictability around this earnings announcement. So this must be due to private information related to cash flows. Okay, so that's our argument.
Thank you very much for your explanation. I think that's satisfactory to Suk. So thank you very much for that. I'll just take the next one from Aoyang Wu. Your speech was truly wonderful. Good afternoon. I want to write an equity research report on Xinxiang with a core focus on demonstrating the company's investment value through multidimensional analysis and providing the buy rating along with the target stock price recommendation. from which aspect should I approach and analyze? Could you please give some valuable advice and guidance? By all means, if you have some initial thoughts, Wiping, that's absolutely fine. Please carry on to do that. Otherwise, Hao Yang, you can always reach out to Wiping. Email is accessible through, if you just do a Google search with JCUS, you'll be able to reach out to her for further guidance. But by all means, if you have some immediate comments, that would be useful because others may also find the advice useful. Please, Wiping.
Yeah, thanks, Hao Yang, for this question. Actually, I know this is a much broader question, not tightly related to this paper, right? I think you have my email, you have my WeChat. So if you want to have some further discussion, we can just communicate in that way.
Good.
Okay. Yeah.
Good. That's very fine. Yes, that's fine, Yang. So please, if you've got further questions, by all means, use the chat. The Q&A button. Very interesting paper, Wiping. Very interesting, strong data work, and I like how you sort of cleaned the bond data, and it's sort of how to do an event analysis. I think there's a lot to learn in terms of how you've approached your methodology, especially on a week-by-week basis. It was also good to see some of the interactions between, things like distress risk, behavioral issues, but also the things like the materiality of credit rating changes, right? So ideally, one would have hypothesized that maybe that would matter, but I think very importantly, because it's already public, that's an interesting finding to look at. But also, the institutional investor trading and out, this is very important, also very, very useful. I was probably a bit interested in terms of the theory aspect of things. So what sort of theory do you think this paper should be framed along, because I'm just thinking ahead that maybe journal reviewers, some may be interested in, what's the theoretical framework here and what's the contribution to theory. So I don't know if you have some immediate reflections on that.
Yeah, so our paper is actually an empirical paper, but we try to strengthen the theoretical part. So we actually contribute to the literature in the following ways. The first way is about the market efficiency, right? So people tend to believe efficiency occurs in more liquid market, but we show that that's not always the case, right? Second one is about it's more like behavioral finance because typically investors in the stock market, due to less attention or some behavioral bias, they tend to ignore the information from the other market, right? So that's why we say this bound to stop predictability occurs. Yeah. So that's about the theoretical parts we can think of.
Thank you. I think that's very straightforward. And of course, when you were answering the first question, you made reference to one of the potential explanations for it, maybe potentially overconfidence, right? So that lends itself, like you said, to the behavioral finance literature. So I think that's something to maybe strongly consider moving forward. But I think very interesting paper. And I think whether you're a finance colleague or accounting or accountability or ethics or you would have found something useful, whether from the methodology aspect or from the crafting of the paper aspect. So thank you very much. If you have final question, by all means, we can do that now. Otherwise, I'm going to sort of to a close. So I just want to thank you once again, Wiping, for your very interesting work and for your presentation this evening. I also want to thank colleagues that have joined us across the world. Very good turnout. I think we've got about just going to check how many. So we've got 18 participants. And I think a few has dropped off already. So thank you very much for joining. You will get details of subsequent seminar series after now. So a big thank you to you, Wiping, and also a big thank you to my colleagues, Nicole Delacroix and Nicole Yap, for their very diligent work in organizing this. So we are going to share with you a satisfaction poll, which just tries to capture your views on how the seminar has been. So by all means, please do that before logging off. So finally, a big thank you to all attendees, to our presenter, to my colleagues once again, and putting this together, and see you at the next webinar. Thank you.
Thank you. Thank you all. Bye-bye.
Thank you all.